The crypto landscape is undergoing a seismic shift, with traditional financial giants like BlackRock taking center stage in the custody of digital assets. This marks a significant departure from the past, where exchanges were the primary custodians of cryptocurrencies. But here's where it gets controversial. Does this signal the decline of decentralized platforms, or a new era of collaboration between old and new finance? Let's dive into the details. A new era in crypto custody. For years, cryptocurrency exchanges like Coinbase and Binance have been the go-to places for storing and trading digital assets. However, recent developments suggest that the tide is turning. BlackRock, one of the world's largest asset managers, has emerged as a formidable player in the crypto custody space through its Bitcoin and Ethereum ETFs. This move has significant implications for the industry, particularly for established exchanges. BlackRock takes the lead in Bitcoin custody according to data from CryptoQuant.
BlackRock's spot Bitcoin ETF, known as IBIT, now holds a staggering 745,357 BTC. This figure surpasses the holdings of both Coinbase, 706,150 BTC, and Binance, 584,557 BTC. The rapid accumulation of Bitcoin in just a few months highlights a pivotal moment in the crypto ecosystem, where traditional financial institutions are increasingly favored over centralized exchanges. This shift is not just a numbers game. It represents a broader trend towards regulated and secure investment vehicles. Institutional investors, wary of the volatility and regulatory risks associated with exchanges, are opting for ETFs, which offer a more stable and transparent way to invest in cryptocurrencies.
The second quarter is worth saying. There are two types: IBIT, Coinbase, and Binance, around 200. The differences are stark. IBIT, Coinbase, difference: a plus 160,800 BTC. These numbers reflect a growing preference among institutional investors for ETFs over direct exchange custody. The 30-day moving average of inflows on exchanges has hit its lowest point since May 2023, indicating a clear repositioning of investor strategies. Ethereum ETFs, the next frontier. While the focus has been on Bitcoin, a similar trend is emerging in the Ethereum market. BlackRock's Ethereum ETF, iShares, now holds 3.6 million ETH, putting it just 200,000 ETH behind Coinbase, which currently holds 3.8 million. Binance leads with 4.7 million ETH, but its growth has slowed compared to the rapid accumulation by the ETF. Since August 22nd, over $1.5 billion have flowed into ETH ETFs, including a single-day influx of $450 million. Despite these large inflows, the 30-day average volume of inflows on exchanges has dropped to just 25 ETH per day, a level last seen in April when ETH was trading at around $1,700. This discrepancy suggests that investors are increasingly favoring the security and regulation offered by ETFs over the liquidity and flexibility of exchanges. What does this mean for the future? The rise of BlackRock and other traditional financial institutions in the crypto space raises important questions about the future of decentralized platforms. Will exchanges like Coinbase and Binance adapt to this new reality, or will they gradually lose their relevance? And this is the part most people miss. This isn't just about competition. It's about the evolving nature of the crypto ecosystem itself. Chapter: Controversy and Discussion. The entry of BlackRock into the crypto space has sparked debate. Some see it as a positive step towards mainstream adoption and increased regulation, while others fear it could lead to the centralization of the very assets that were meant to be decentralized. What do you think? Is the involvement of traditional finance a boon or a bane for the crypto community? Share your thoughts in the comments below. Maximize your CoinTribune experience with our Read to Earn program. For every article you read, earn points and access exclusive rewards. Sign up now and start earning benefits. Disclaimer: the views, thoughts, and opinions expressed in this article belong solely to the author
and should not be taken as investment advice. Do your own research before making any investment decisions.